Talk Media Limited, where complex ideas are explained clearly. Hi, I'm TaxMax. Let's break down today's tax topic.
Fact: corporation tax is paid by UK companies on their profits. After a management buyout, attention often turns quickly to running the business. But from a tax perspective, completion is not the end of the story. An MBO can create new companies, new group structures, new financing arrangements, and new reporting obligations. Directors must ensure that the tax consequences of the transaction are actively managed after completion, not assumed to be finished once the deal closes. Most MBOs are supported by a tax structuring report and a tax due diligence report. These documents usually identify steps required after completion, recommended actions, and areas of tax risk or uncertainty. Directors should review these reports carefully to confirm whether any post-completion actions remain outstanding and whether ongoing monitoring is required. MBOs are commonly funded using a mixture of bank debt, private equity, and other external investors. Where investors receive shares in the group, they may become connected parties for corporation tax purposes. That connection matters because it can affect whether interest deductions are restricted and how anti-avoidance rules apply to the financing structure. Large groups may fall within the corporate interest restriction regime. As at September 2025, groups with net UK interest expense of £2 million or less are generally outside the CIR regime. Above that de minimis, interest deductions may be capped and reporting obligations may apply. Transfer pricing rules can apply in MBO structures where multiple persons act together and collectively control the company's financing. If transfer pricing applies, interest rates must be arm's length, and excess interest may be disallowed for corporation tax purposes. In some cases, groups seek advance agreements with HMRC to provide certainty over deductible interest. Special timing rules can affect interest deductions in certain situations. Where loans involve close companies and participators, or certain pension trustee arrangements, interest may only be deductible when paid rather than when accrued if payment is delayed beyond statutory limits. MBO structures can also give rise to trapped losses, including non-trading loan relationship deficits in investment companies. Losses arising from 1st April 2017 can generally be carried forward more flexibly, but use may be restricted, including a 50% restriction on profits above £5 million, and the computational rules are complex. MBOs generate a wide range of costs, including corporate finance fees, legal and advisory costs, bank arrangement fees, and due diligence costs. Tax deductibility depends on whether costs are capital or revenue, and which company in the group incurs them. Many acquisition-related costs are capital and not deductible, while certain financing-related costs may qualify for relief if conditions are met. Investment companies may deduct investment management expenses, provided they are not capital in nature. However, deductibility can depend on timing, particularly whether costs are incurred before or after a firm investment decision. Management often acquire shares as part of an MBO. The company issuing those shares must report employment-related securities events to HMRC using the online reporting service and meet the 6 July deadline following the tax year of the event. Failure to report can result in penalties. An MBO often creates a new or enlarged group. Directors must ensure HMRC notifications are made, corporation tax returns are filed on time, payment deadlines are met, and dormant companies are dealt with correctly. Changes in group size may bring companies into the quarterly installment payments regime, accelerating corporation tax payments. A change in ownership can restrict the use of losses, particularly where there is a major change in the nature or conduct of the trade or investment activity. Non-coterminous accounting periods can also complicate group relief claims. Other taxes may also need review, including stamp duty on share acquisitions and VAT group changes. In summary, an MBO does not end at completion from a tax perspective. Directors must follow through on tax recommendations, monitor financing and losses, and maintain compliance across the group. And this brings us back to the fact we opened with. Corporation tax is paid by UK companies on their profits. After an MBO, those profits can be significantly affected by financing costs, loss restrictions, and compliance failures, which is why post-transaction tax management matters. What's a tax lover's favourite dance? The deduction shuffle.
Educational content only, not advice. Rules can change. Thanks for watching. Clear explanations, one place, Talk Media.